Today's presentation will center around some of the most important things for you to keep in mind as you explore capital options. And our presenters will walk you through tons of ins and outs of this really important topic. So I'm pleased to introduce our presenters today. Our experts today include my colleague, Shauna McLaren, who's our Director of Working Capital at Accion Opportunity Fund. Thank you so much for being here, Shauna.
Thank you, Meredith. That's really exciting to be here. And thank you to Start Small, Think Big for the partnership and co-hosting this great webinar with us today.
Awesome. And I'm also excited to welcome my colleague, Lindsay Chung, who serves as a partnership manager here at AOF. We're so glad to have you here as well, Lindsay.
Oh, here.
All right, so let's go ahead and get started with this conversation. So I will turn things over to Shauna.
Okay, thank you. And good afternoon to everyone. I'm based here in San Jose, so shout out to everybody that's in the Bay Area. We're excited to be here, and we'll be talking briefly about how to access capital for your business. As the end of the year is quickly approaching, I'm sure you're all thinking about what your goals are for 2022. And so accessing working capital is a critical step to reaching many of your goals. And so we're hoping to help you through that. And today we're going to be talking about various topics, including first, formalizing your business finances. Then we'll talk about how to assess your current situation and what your cash flow needs are so that you can find the right product that will fit those circumstances. And then lastly, we're going to walk you through how to get prepared for applying for funding. And then to wrap up, we'll just do a brief overview of Accion Opportunity Fund's loan products, including another grant program that is for nationwide businesses. So stay tuned all the way to the end to get more information about that. So first, we'll start off with formalizing your business finances. And so this is just 6 steps to take to formalize your business. Many of you have probably already taken these steps, such as creating a legal structure and a name, getting a tax ID number, or setting up a business bank account, which is super important to separate those business activities from your personal activities. If you haven't taken all of these steps yet, we really recommend that you do it sooner rather than later. Most lenders are going to want to see some sort of proof that most of these steps, if not all, have been completed in order to consider financing your business. And okay, we'll move on to the next slide. It's okay. It's okay. I was just going to wrap up and say that, these steps will help you not only just with working capital, but also it may help you secure contracts, especially government contracts, perhaps partnerships, and overall expansion. So now we can go on to the next slide. Thank you. So it's always really important as you're considering applying for financing to make sure that you understand what your business's current financial situation is. And so the best way to do that is to review the 3 financial documents that are shown on this slide. And I know most of us are not financial gurus, and we're not asking you to be, but it is important to understand these documents and the basics about what they mean. So a profit and loss statement is also known as an income statement, and it essentially just shows you a financial picture of the activities in your business, mainly the sales that you're bringing in and the expenses that you're paying out to run your business. Next, the cash flow statement it shows your cash flow position over a period of time. So again, it shows money that's coming into your business from sales or investments that you put in, and then also money that's going out of your business in terms of if you're through operations or if you're purchasing equipment. So it's really vital to understand cash flow, especially when you're figuring out how much you might need to borrow for your future goals. And then lastly is the balance sheet. The balance sheet is just a snapshot of your financial position in any single point of time. So it shows the assets in your business. So that's mainly your cash or accounts receivable or equipment. And then it also shows your liabilities. So your accounts payable or your debt. It's good to make sure that this is that this is accurate, and you can kind of see the trends over time as well. And generally, in addition to these 3 documents, banks are going, or excuse me, lenders are going to want to see your business bank account. So again, if you, it's important to make sure that you do have a separate bank account for your business in order to separate those financial transactions from your personal statements. And then moving right along, we're going to move on to just understanding your credit and your overall cash flow needs. So cash flow, again, is just cash coming into your business and going out. One way of tracking your overall cash flow is to understand your cash flow cycle, which is just an indication of how long it takes for you to turn your product or service into cash, money in the bank. So for example, if you are a grocery store, you may buy your produce from the farmer on a daily basis, and then, so that's cash in, and then you may sell that same produce that same day, and that's cash that you're getting in for the produce. So in that case, your cash flow cycle is 1 day. But if you are a consulting business, for instance, your cash flow cycle will be longer because your projects most likely tend to be longer term. So it may, your contract might be 2 or 3 months. So it may take that long for you to get paid for your services. So in that case, your cash flow cycle is 2 or 3 months, depending on the contract term. So that's just something for you to keep in mind as you're planning your expenses, especially for bills and debt payments. It's good to understand that process. And then on the next slide, we'll move into credit. So why is credit important? You know, employers evaluate credit when doing background checks. Lenders use it obviously to evaluate your ability to repay debt. And insurance companies use it to determine your risk level. So bottom line, having good credit means lower rates and better opportunities. When lenders are looking at your credit history, we're looking at 2 major components. So we're looking at your credit score, which can range from 300 to a high of 800. And then we also look at your credit report. That's really what is giving the full story behind the score. It shows things like your identifying information, all of your old and your existing accounts, inquiries, liens, collection accounts, etc. So it's important to check your credit report at least once a year to make sure that everything is accurate and that you have a good idea of what lenders will be looking at. And then if there are inaccuracies, then you can then try to correct those. So correcting small things like a past due cell phone bill or parking tickets if you haven't paid them, that can really make a big difference in your overall score. One way on the next slide that you can see of how to pull your credit is going to annualcreditreport.com. Generally, under the Fair Credit Reporting Act, you have the right to get a copy of your credit report free of cost once a year. Right now, because of COVID, the 3 credit bureaus, Accion, TransUnion, and Equifax, are actually allowing you to pull your credit report once a week free of charge. And when you're pulling it yourself during these allowed periods, it's not affecting your credit score. It's really just allowing you to monitor your activity and ensure that it's reported correctly. So in terms of what affects your credit score, credit is a mystery to a lot of us, but you know, there are some main factors that affect your score. The 2 biggest ones are your payment history and your credit history. So, and we all know that the road to entrepreneurship is bumpy. So you may not have perfect credit. I mean, who does? Most lenders will understand that. And when they're looking at what your payment history is, it really depends on a variety of factors, such as how long ago was your last past due payment? How often were you late? Did you eventually bring those accounts current? You know, it's really preferred that if you did have a late payment that you have already brought that current, or you're working with the creditor on a payment plan to show that you're actively trying to resolve those issues. So that is a lot better than allowing your account to go delinquent and be charged off. And then when a lender is looking at how much you owe, similarly, there's a lot of factors to that. So like, what is your overall balance? Are you close to the max of your credit cards? So for credit cards, if you are maxed out, most lenders will view that as that you're already pretty stretched pretty thin and may have too much debt, even if you are making payments on time. So just some tips to consider as you're looking at your credit history. And then on this slide, I know there's a lot on it, but it's just a quick look at some of the things that may negatively affect your credit and for how long. The important thing here is to keep in mind that credit mistakes don't last on your credit report for forever, although 7 years sometimes feels like forever, but they will eventually fall off and go away. You just need to, make sure that you continue to be diligent, that you work with your creditors, keep them updated, and over time your score will improve. And the slide and this deck will be made available to you after the presentation, so you don't have to furiously write down these items here. And then lastly, just some overall general tips about building your credit. We've talked about paying your bills on time, making sure that you're not totally maxed out. One thing that not everybody knows is to make sure that you keep your old accounts open. Having a really long credit history can really help in improving your score. So, and try not to constantly apply for new credit. Those too many credit inquiries can drop your score over time. So it's a journey, a marathon, not a sprint, as you'd say. So, again, just be patient, stay positive, continue to be proactive about it. And so now I will turn it over to my wonderful colleague, Lindsay, to talk about different funding options that are available for your business.
Great. Thank you so much, Shauna. And thank you all for joining us here today. We're excited to collaborate with our partners and share this information with you. So if we've already formalized our business finances and we fully understand our cash flow and our credit, it's time to explore our funding options. So I don't have to tell you that it can be really difficult to manage your cash flow when you're first getting started. Oftentimes there's not many financing options available, and so people start out with using their personal savings or possibly some additional income or loans from friends and family, and at a certain point that runs out, and many small business owners assume that they can just go to their bank and get a loan. But 8,000 small businesses are declined from a bank on a daily basis. Oftentimes banks are looking for more well-established businesses and higher loan amounts. So this leaves a large gap in the financing market, and a lot of lenders are coming in to fill this gap. They come in different shapes and sizes, and it can be really difficult to navigate this space. So today we're going to go over the different options that are available, give you some tools on how to compare those different options and find the right financing for you. So this gives you a good idea of the different financing that's available at different stages of your business. It also shows us the pros and cons of each of these options. So let's get started with new businesses. As I mentioned in the previous slide, it can be difficult to get regular bank loans or loans for your business when you're getting started out. So oftentimes support of friends and family and your own savings is a very helpful tool. There are other options. Some people find giving equity or finding an angel investor a good option because they may have a very capital intensive business that can scale very quickly. Another popular option is crowdfunding. This can be really helpful for your small business owner if you've got a great network, a good story, or want a proof of concept. As your business grows, there will be more and more options available to you. So if you have an established business, I'm sure you've already received phone calls and emails from lenders offering quick and easy cash, and these are typically from these alternative institutional lenders. So this includes online lenders, merchant cash advances, peer-to-peer lending, and other groups like that. Oftentimes they're banking on their ability to collect and not your ability to pay. So they don't need a lot of documentation up front, which makes the process go very fast, but also you don't have much time to pay it back. They try to get their payments very quickly to reduce risk on their side. Another great option is community lenders. So this includes micro lenders, SBA lenders, CDFIs, and other credit unions. Accion Opportunity Fund is a certified community development financial institution, and we have much more flexible underwriting guidelines than you would typically see at a more traditional bank. Our funding process does take a little bit longer because we're really focused on making sure that we get you a loan that you can easily afford. And then we have established banks. So established banks are definitely the most affordable capital in this space, but they do tend to take a little longer. So let's take a little deeper dive into each of these options. So to start, SBA and bank loans, as I mentioned, it's a longer approval time, usually between 1 to 6 months. And oftentimes they do require collateral and want to see that the business has been in operation for at least 2 years. However, the APR on these loans are very low. There is an SBA option that's available to startup businesses. It's called a 7A loan, and it's offered by a few CDFIs. And for this, you typically need a cash infusion, so somewhat like a down payment. They need to see that you have money to invest in your business and also experience in the field. So CDFIs could be a really great option if you're growing and you need a loan, but maybe don't have the time in business that banks are looking for, or just don't have all the requirements that a typical bank looks for. The interest rates generally start at around 9% and go up to 30%. And the funding is a little quicker. It's generally in about 2 to 4 weeks. There's also merchant cash advances. So this is not a loan. They are buying future receivables from you, and you pay them back by giving them a percentage of your credit card sales on a regular basis. So every time a sale goes through, you're paying your lender. This tends to be a really short-term loan, and the higher your sales are, the quicker that you pay off this type of loan. This cost for convenience is very high. Generally, the APRs are 40 to 350%. You may be really shocked at that percentage, and we'll kind of go over how they sometimes present the pricing so that you have an understanding of why there may be some confusion in what the true cost of those loans are. Then there's also daily and weekly ACHs. These are similar to MCAs, except they take the payment directly out of your bank account on a daily or weekly basis. This will be the same payment every time. It is very fast to get these funds, and your repayment term is very short. This gives us an overview of some different terms that we use in the lending space. It also goes over how to calculate your APR. I wouldn't get focused too much on the calculation because there are great calculators out there that can help you figure this out. But just to go over a few terms, principal is a loan amount that you are given. The term is how long you have to pay that off. The interest rate is a percentage of the principal that you pay back with the principal. And then oftentimes lenders have an origination fee. This could be a percentage or a set amount of the loan. And the APR includes both the interest rate and the origination fee. So it can be a helpful tool when comparing your different lending options. Most lenders will present the APR, but if they don't, make sure that you get a full breakdown of what the cost of the loan is, so you know exactly how much you will be spending on it. Some lenders do advertise maybe a weekly or a monthly interest rate, which could be very different. So if they advertise 10% interest, this ends up to be over 120% APR. So on the example we have here, it means your monthly payment will be about 3 times as much, and you will be paying back about 3 times more than you would for an APR that's only at 10% per year. So then we also have a factor rate. I wouldn't get too concerned about the details here, but if you have a lender that comes to you and says, I'm going to give you 10,000 today, and I want you to give me 10,000 or 10% of your sales until you pay back 14,000, it can be really difficult to understand how much you're really paying for that loan in the long run. So as I mentioned, there's great calculators out there to help you understand that. To give you an idea, in this scenario, the APR would end up being well over 100%, which could hamper your business's ability to really grow. And then we also have daily and weekly ACHs. You are responsible for making this regular payment, whether you have good sales or not. And this can be somewhat burdensome on a business. So it's only a good fit for very specific purposes. For example, if you are a flower shop and you know that Valentine's Day is coming up and you need to order a lot of flowers, and you know that you will sell them in the next couple of weeks, and then you'll only have to take care of this daily or weekly payment for that short period of time, then it may be a good option. But for some small businesses with volatile cash flow, it can be very dangerous because, if you have a drop in sales and you still have to make that payment, it may result in insufficient fees with your bank and may hamper your ability to make your regular payments on things. So you may be asking yourself, how do you know if you're talking to a predatory lender or not? And how do you find the right person for what you're looking for? And here is a long list of questions. We encourage you to ask these to the lender. And if they seem hesitant to answer these questions or kind of around the bush, I would encourage you to look at other options that are available, because this is a very important relationship and you're trusting your business to these people. So you want to be with a lender that's really upfront and honest with you. And so make sure that you keep these questions handy as you're speaking with lenders. So there's a number of different things to consider when evaluating a loan. So we talked somewhat about the repayment structure and what that would look like for a small business. But another important factor is the cost of the loan, and to look at the requirements for the lender. So some lenders require collateral, or they may have a minimum FICO score. And so to understand their requirements before you apply, that can really help save you time and make sure that you don't have an inquiry on your credit report when you weren't a really good fit for that program in the first place. So it's good to find a lender that is willing to work with your specific profile. Another good tip to have is to try to time your payments to a time where you have high cash flow. So if you get most of your payments in at the beginning of the month, it's great if you can try to time your loan payment with that time where you have a lot of cash flow, so you're not struggling to piece together some things to ensure that you have enough money for that loan payment. All right, so now it's time for us to prepare to apply for funding. So oftentimes small business owners are wondering, what does it take to get a small business loan? This is nothing we ever learned in school, and I think oftentimes it's a mystery for small business owners. So one of the biggest things that matter to lenders is your willingness and ability to pay, and that goes around cash flow. So we often look at your income, so the business revenue. And a good rule of thumb is typically that lenders will lend about 1 or 2 times what your monthly revenues are. So if you're making $5,000 a month, it will be really difficult to get a $100,000 loan, especially from a responsible lender, because they want to make sure that you have enough money to grow your finances to pay back the loan. Some lenders will look at wages from an outside job. And this can be really helpful, especially in the early stages of your business. So if the business isn't making any revenue or isn't creating a profit yet, if you have that additional income, some lenders will be able to factor that in their decision and see that you do have a method to pay back the loan, which is very important. And then household income is sometimes considered, as long as that person co-signs on the loan. So if you have somebody in the household that has an additional job that will be covering personal expenses and is willing to co-sign on the loan, that will definitely improve your chances with certain lenders. Another important factor to look at it is your debt. And so lenders will often look at things like mortgages, student loans, credit card balances, and they will often compare your income with your debt. So they'll want to see that you have at least 20% more net income than you do debt payments. This allows the lender to know that you have enough money to pay on all your current debt, your new debt, and that you have a nice little cushion there, so you're not strapped for cash at any point. Cash is another consideration. We always encourage small businesses to try to save in case something unexpected happened. Our good rule of thumb is that you should have about 6 months of business expenses in your savings. I know that's very difficult, but I think we've all learned over the past 2 years that wild things can happen where you may need to access those funds. Cash can be really helpful, especially when you're looking for a startup loan. As I mentioned earlier, a lot of lenders will want to see that you have some buy-in to the business when they're lending to you. So they'll often want to see that you can put 10 to 20% of cash into the business, or that you've already invested that before they'll approve you for a loan. So savings always comes in helpful. We went into depth about credit score, so I won't go too far into detail about that one. And now it's time to talk about collateral. So some lenders require that the loan is fully collateralized. The most common type of collateral that's used is a UCC. This is a business loan on your business asset, or it's a business lien on your assets. So this means that if you're unwilling or unable to pay on the loan, the lender has the ability to liquidate those business assets. Other collateral that are used on loans are mortgages, vehicles, AR inventory, things of that sort. It really depends on the lender and what they are willing to use as collateral on your loan. Another important factor is connections. So that could be time in business or the type of industry experience that you have, access to network and peers, and community involvement. Something we don't have on the slides that's really important to also think about is conditions. So there's external conditions, like how the economy is doing. If it's a fairly uncertain economy, then lenders might be a little stricter in their underwriting guidelines. And then there's also internal conditions. So that could be the use of the loan or the type of industry that you're in. These are all factors that lenders are thinking about when they're underwriting your loan. So each lender may have different application requirements, so it's good to check with your lender. But some common things that most lenders will look for are tax returns, business and personal. Generally, they'll want 1 to 2 years of tax returns. So it's important to be reporting your successes on your taxes, because oftentimes lenders are looking at that to determine your ability to pay back the loan. I've seen year-to-date financials be more important than ever, just because 2020 taxes aren't the most accurate reflection of how a business is doing. And so many lenders are relying more on their financials when they're underwriting loans. Let's go down to credit check or background checks, since we've gone over a lot of the other items. For larger loans, they sometimes want a background check. And so if you have something that may show up on a background check, it's good if you talk with the lender up front about those items. Oftentimes they'll look at it more favorably if you bring it up, as opposed to them finding out. You can find out if you can work with a lender on those items. For example, at Accion Opportunity Fund, we can work with people who have tax liens on their business typically, but you would need to have a payment plan in place. And so we would want to make sure that we have that conversation before we go through the application process. Another important thing is statement of use. I can't tell you how many times I ask the small business owners how much they want, and they come back to me saying, well, how much can I get? And I feel like that's not the best thing for you to say to a lender. I really encourage you to do some research, figure out how you can really leverage those funds to pay back the loan, because that's what the lender wants to see. So I love it when people come to me and they say, I need $75,000 and this is going to help me hire 2 employees and buy this piece of equipment, which will increase my sales by this much. This makes me really confident that this client knows what they are doing, they've done their research, and that they're prepared to make sure that they use the funds effectively and pay back the loan. All right, so I'm going to go ahead and pass it back over to Shauna, and she's going to explain a little bit more about who Accion Opportunity Fund is.
All right, thank you, Lindsay, and thank you so much for going over all of that really detailed, somewhat heavy information, but it's important, I think, for everybody to just get an overview of a lot of those terms and what to look for when evaluating different options for your business. And so I'm going to try to go through these next final slides relatively quickly so that we have enough time for all of the great questions that I've seen go on in the chat. So just briefly about who Accion Opportunity Fund is. We are a private nonprofit small business lender that's really focused on helping women, minorities, and underserved business owners get access to financing when they don't have, when they're not able to obtain it through traditional sources like the bank or small business administration. And we do this through partnerships and outreach strategies, and try to provide affordable alternative financing, business advising and coaching, and educational resource and networking opportunities like this one. So, and on to the next slide. We've been doing this for over 27 years now. We've worked hard to invest over $1 billion in underserved entrepreneurs and communities, and always focused on helping small businesses create and retain jobs, with over 50,000 jobs being affected by the work that we're doing here. And even during the pandemic, we did close to 3,000 loans to help small businesses and communities, and hope to continue to do that going forward. Our footprint is 45 states across the country. Our portfolio has always been generally pretty diverse. And also we're really focused going forward on lending to women, Latinx, and Black entrepreneurs, as they have been the most underserved and had the most difficult time during the pandemic, especially with accessing financing through PPP and other federal programs. So we have a few different products. Our main product is our working capital loan. That's just standard working capital up to 100,000, between 5,000 and 100,000, that you can use for general business purposes. We just require at least 1 year in business and 50,000 in minimum annual revenues, and then just pretty basic documentation. Our terms are up to 60 months and interest rates starting at 5.99% based on your overall credit profile. And we do invite those that are ITIN holders. You are welcome to apply across the country, actually, not just in California and Nevada. And then moving on to the next slide, we do have a commercial vehicle finance program. This is actually only available in California, Indiana, and New York. The funds can be used to purchase big rigs, box trucks, delivery vans, mobile food. Startups in this category are okay, as long as you have at least 1 year driving or industry experience. Terms also up to 60 months, interest rates ranging between 9.99% and almost 15.5%, depending on the product and how you're going to use those funds. And on the next slide there, we do have a special program for specific states, and I apologize, my triangles are coming in and disrupting my slide here, but you can go back one more. But yeah, so there is a program called SOAR, the Southern Opportunity and Resilience Fund. This is a special low-cost loan that's subsidized by a group of states in the southeastern region of the country. There's also a similar program called California Rebuilding Fund, specifically for businesses just in California. These are for businesses with less than 50 employees and less than $2.5 million in revenue. For those that started in 2019 and were affected by COVID. Loans are up to 100,000, up to 72 months. Interest rates are lower, as I mentioned, between 4 and 4.5, and interest-only payments for the first year. So this is really flexible guidelines, I think one of the most attractive loan products that are available outside of the SBA right now. And you can go to the link that's provided there to learn more and to apply. There is a pre-application that you have to fill out first, and then get access to the main application. And then last but not least, I did promise to give you some information about our grant program. This is a grant called Fast Break for Small Business in partnership with LegalZoom. They accept applications until November 23rd, so that's coming up. We do encourage everyone to apply for a grant. Everyone loves free money, but they're always very competitive and limited in quantity, and it takes a while to get your money if you are lucky enough to get awarded. So always keep that in mind, and we encourage you to, in addition to grants, to also apply for loans. And we did go through a ton of information here. Here's some contact information for you. If you have any further questions, need something clarified, we're here to help you. And there's a ton of resources available on our website. Also, if you need some more specialized educational resources. So thank you so much for your attention this afternoon, and happy to open it up for questions.
Wonderful. Thank you so much, Shauna, and thank you, Lindsay, for going through all this information. We've got a few minutes here to take some questions from our audience today, and we've got a couple really good ones that I definitely want to go through, but folks, feel free to pop more questions in the chat if you need them answered today, and we can get you some answers. So the first question will kind of go chronologically in terms of formalizing the business, understanding credit, understanding options, applying. So for formalizing the business, we had somebody ask a question about business bank account that says, my business account, many business accounts require a larger amount of money in the account daily. Do you all know any examples of financial institutions that don't require a minimum balance? And I know this can be difficult because geography might matter in this situation, and different banks offer something different for different business types. But is it safe to venture a guess that a credit union might have a lower minimum than like a big bank traditionally? I don't know, Shauna, what do you think?
Yeah, I think that's a good assumption. It's always good to look at what's available locally in your market. So I think they'd be more sensitive to the needs of the local community.
Yeah, that's a great idea. Okay, cool. So yeah, check out a credit union. And then we had another question. We had a couple questions come in about the difference between business and personal credit, and questions about why, if I'm trying to get a business loan, why are they looking at my personal credit if I'm getting a loan for my business? Do you mind explaining a little bit of the difference there?
Sure. Yeah, I know this is a common question. It doesn't always make sense to everybody. But as small businesses, lenders do tend to view you as an individual as a reflection of the business. And especially if you don't have a whole lot of operating history, they use your payment history to kind of project how the business might operate and how the business might pay its bills. So we do, Accion Opportunity Fund, we pull both reports. So we pull your credit report as well as your business report. The business credit report we pull through Accion, as well as another company called PayNet. So we try to balance the history from both. And it is important to know what's on both reports, make sure that that's accurate as well.
For sure. Okay, thank you. And then another question about credit. We had a couple people ask this. If a business has two partners and one of them has stellar credit and the other partner maybe not so much, how might that affect their ability to lend, or what's a way to sort of maybe get around that?
Yeah, I mean, this is also fairly common. First, I would say make sure that you fully understand what's on the credit reports for both partners and see if you can improve the score for both of you. And then it's always important when working with a lender to disclose as much information about your credit or your background up front so that the banker can give you a relatively quick answer as to whether or not you would meet their credit criteria. So with AOF, for instance, we'll take an average. We'll average the scores between two partners and they have to meet our minimum, but not all lenders do that. And so it's, it is a lot of work to talk to these lenders. It's like a whole nother full-time job, but it's good to just disclose as much up front so that you don't have to waste time with a lender that you may not just you may not qualify for right now.
All right, that makes a lot of sense. Oh, we have so many great questions coming in. Thank you guys for being so engaged in this discussion. So we had a question, Shauna, I think you already kind of spoke to this, about how do you build business credit on your business credit profile instead of on your personal credit? Anything that you want to add on that?
I think the easiest way to get started is a business credit card. And then obviously business loans or a car loan in your business name. I don't know, Lindsay, looked like you were going to say something as well.
I think it's helpful when you're talking with lenders or vendors to see if they're willing to report on your credit, because some lenders do and others don't. And so that could help you also when you're evaluating which lender to go with, is if they're able to help you kind of build up that credit.
That's a great idea. Okay, cool. All right. And then we had a couple of a little bit more logistical questions that I think actually I can take. So what kind of educational resources do we have? So at AOF, we offer webinars like this all the time, at least a couple times a month. And we also can provide access to a ton of articles on our website. We have about 400 small business resource articles, and the back catalog of our recorded webinars are available there. We also have a number of free online business courses that you can take. So interactive courses where you can learn about different business topics. So lots of educational resources. And then we also provide one-on-one small business coaching through a couple of coaches who are full-time staff members. That's all they do all day, is talk to clients and help them sort through their specific challenges and set goals and kind of track progress there. So you can find all of that on our website. And then our partners at Start Small, Think Big also have quite a number of resources available as well. So we'll send, like I said, we'll send lots of detailed information to you so you can learn more about what we offer. And then a question about the grants. So the Fast Break for Small Business grant program with LegalZoom and the NBA, how many people are going to be awarded grants? That program is going to run twice a year. And so this is sort of our fall winter season, and then it'll run again in the spring. And at each of those times, 50 people will be awarded $10,000 each. And then an additional 950 people will receive credit to use LegalZoom services. So credit toward getting free services or heavily, heavily discounted services from them. So encourage you to apply for that program as well. And we are recording the session. I'm just running through all these questions. So we'll send the recording via email shortly, so you can get access to it there. Okay, and then we had a couple questions about business plans. So Lindsay, I'm hoping you can help us with this, because a couple people are saying in applying for loans or grants, don't they need to have a business plan ready before they talk to the lender? What would you advise there?
I think a business plan is always helpful to have. I would say it definitely depends on the lender whether they will require it or not. We don't require it for our program, but if you're looking for a startup loan, I almost guarantee that they will require that you have a well thought out business plan. And we have business advisors that can help you kind of walk you through that process, and some of our educational materials can also help. So I think it's definitely helpful for you to have a plan. Whether a business or a lender will require it or not is up to the lender.
Okay, sounds good. All right, and then Ian, I would love to bring you back in for one question as the financial program manager at Start Small, Think Big. We had somebody ask about what it means to formalize your business finances. And I know that's something that you are an expert on helping folks with. So can you walk us through a couple of those things, remind us how to formalize business finances?
Yeah, so that phrase formalizing is maybe a bit nebulous. Really depends on kind of what you're trying to do. So, right, a sole proprietorship might just be talking about the doing business as, that I think was mentioned in the question. Seller's permits might be required in certain states, like in New York, that's called a certificate of authority. The idea that I hear a lot about is like a business license isn't really a standard thing. Some states have it, some states don't. It really does just depend. So I think this is kind of along the lines of that question around, like, why does my personal credit matter for if I'm talking about my business? And it's always just a question of the lender trying to get as much information as possible. So if there's a well-established long history of a big business, there's less need for them to look into personal information. It's still likely going to be looked at unless you're really like a Fortune 500 company. But all of those things get kind of used in the equation of, is this business credit worthy or not, or to what degree, what are the terms going to be? So all of these things can be used, and none of them necessarily prevent you from accessing a business loan, right? You don't, it depends on the institution, the product you're asking for, but just because the use of the loan is for business purposes doesn't mean that there's only a specific type of business that can get it. So unfortunately, not a direct answer to that. A lot of different considerations that go into it. Hopefully that's helpful.
Yeah, that definitely is helpful. I have definitely had clients who are a little bit panicky when they hear the phrase business license, because that's not something that's either relevant to their industry or that's not what their state calls it. And that's sort of an umbrella term that could mean a lot of different things. So nobody panic. We're here to help you figure it out. All right. So I think that is all the time we're going to have for today, but I really want to thank each of you, Lindsay and Shauna and Ian, for your time, for joining us today, sharing your expertise. I want to thank everybody who joined to learn with us today. Taking the time to invest in the future of your business through learning opportunities like this is a very big deal. We really appreciate the time and want to be a part of helping you grow your business or reach your goals. So appreciate everybody joining. And we hope you feel better prepared to kind of take that next step, assess these capital options. And we will be following up with more information in your inbox shortly. So thanks, everybody. Hope you have a great day.
Thank you. Bye-bye.
Thank you all.